Welcome, everyone. My name is Chris Mayo. I'm Head of Primary Markets for the Americas at the London Stock Exchange Group, and I guide companies from the Americas in doing secondary listings and IPOs in London. In fact, we have a number of companies from the US healthcare space, which are listed in London, which are presenting at the Edison Open House Global Healthcare event. The London Stock Exchange is proud to be able to support this event in conjunction with Terlouw, and it will be delivered through our Spark live streaming platform. Today, we have a great panel for you. We have a number of industry experts from Silicon Valley Bank, from LifeArc Ventures, and from Primary Bid. So if I can move on to the panelists and let them introduce yourselves. Perhaps Claire, you could start and then give a brief introduction on yourself.
Sure, thank you, Chris. So I'm Clare Terlouw. I'm the head of ventures at LifeArc. You may know LifeArc. It's a large independent UK medical charity. I joined in the middle of last year to develop and implement a strategy for our investments across life sciences and to really further our goal of being able to fund and support interesting translational science.
Nooman, how about you?
Thanks, Chris. Hello, everyone. I'm Nooman Haque. I'm head of life sciences and healthcare for Silicon Valley Bank in EMEA. Silicon Valley Bank is a commercial and investment bank focusing on high-tech innovation. I lead the life science healthcare business based out of London and covering all of Europe and Israel.
And finally, James.
Hi there, James Deal. I'm COO of Primary Bid. Primary Bid is a UK-based fintech company that gives retail investors the ability to access public markets alongside institutions on the same terms and same timelines. We are web and app based, and we have a partnership with London Stock Exchange for the UK. And indeed, we're looking at expansion into geographic opportunities internationally.
So thank you all for that brief introduction. I'd like to jump in straight away with some questions. Now, this panel is entitled Alternative Sources of Capital for the Life Science Sector. I think it'd be a good opportunity to start with Nooman, because Silicon Valley Bank released a report recently on healthcare investments and exits, which focused on what had happened on 2020 and compared that with previous years. So I think, Nooman, would you be able to kind of paint us a picture of what you saw in 2020, what the key trends are from an investment and exit point of view in the healthcare sector?
Sure, Chris. I draw your attention to two numbers to begin with, basically, 17 billion and 50 billion. 17 billion is the amount that was raised by venture funds themselves for investment into life sciences and healthcare. Now, to put that number into context, in 2019, the number was just over 10 billion. And the previous 7-year average is more around sort of 7 to 8 billion, which themselves are quite high numbers. And what that tells you is that gives you a really good feel for what the funds available for investment into the sector over the next 3 to 4 years are going to be, because that's the investment investing period of a typical venture fund. So going from just over 10 billion to just under 17 billion in a year is phenomenal, and it reflects the huge amount of liquidity out there. The second number, 50 billion, that is the total amount invested, private capital invested into life sciences and healthcare in the US and Europe. And again, to put that number into context, in 2019 the equivalent number was 34 billion and 35 billion in 2018, the year before that. So a huge increase in the allocation, both the raising of private capital and the investment of private capital as well. We can dig more into the numbers, behind them, later, but I think they really sort of set the context that this is a market that is, on fire, not just immediately, not just in sort of 2020. Normally, I'm inclined to sort of think, well, after such a high year, you're going to see a fall off. There probably will be, but the sheer amount of funds raised, I remember those funds have to be invested into the sector because they're raised by life science specific funds, really sets the sector up for success over the next 3 to 4 years.
Well, I'm probably going to dig into that a bit later, as you say, but I think before, and I actually think it's something that would be interesting, Claire's views on, obviously, is she's a life science VC. But just to dig into those numbers a little bit more that you just raised, could you really talk about the areas that those dollars are being invested in or being focused on, and also from a geographical perspective, if there is any key trend that you're seeing, say, between the US and Europe and Asia? Are there any things you can talk about from that perspective that came out in your report?
Sure. I mean, again, starting at big picture, with numbers like that, it was a record year in Europe and the US. And just again, to put it into context, the Europe total across all subsectors, so that includes biopharma, medical device, and so on, was just over 8 billion compared to just under 6.5 billion last year and 4.5 billion the year before that. So a pretty big increase, in fact. For those that don't follow the sector too closely, there are some consistent trends in terms of where the money goes in terms of subsectors. So biopharma, biotech is usually the biggest recipient. And again, that was no change this year. The number for Europe was about 4.7 billion just invested privately in biopharma alone in Europe, and about 20 billion in the US. And that multiple, if you like, between Europe and the US is pretty typical and a pretty, stable one. Just again, to put those subsector numbers into context, biopharma, we talked about in the US, about 20 billion. Next biggest sector was health tech, which was about half that, about 10 billion. Now, the health tech sector, that has grown massively. There's been a huge increase. It always used to be the sort of third or fourth sector of interest in these numbers that we produce. So for example, in 2019, it was about 7 billion, about 6.5 billion. So jumped up to about 10 billion. And then followed by DX and tools, which had a very strong year, as you'd expect, perhaps in a year dominated by COVID, a lot of interest in testing and diagnostics and so on. So about 8 billion. And then medical devices, about 5 billion in the US. And that ranking in terms of subsector is similar to Europe as well. So again, the big takeaway, biopharma, dominating. And typically within biopharma, it's oncology and broader platform companies that dominate as well. But one of the big stories is, and we've been predicting it for a while, but is this increasing, investment into health tech and digital health.
Okay, thanks, Nooman. I'm actually going to come back to something you've talked about in terms of VC fundraising later, but I want to talk to Claire just briefly first about, you've just talked about the just enormous, amount of capital that's flown into the sector. So my question for Claire as a VC is, there's been a big departure from the past. Suddenly the life science sector, which used to be capital constrained in years past, is now awash with capital. What can investors do? And certainly, you're a private investor. What can you do to be able to differentiate yourself from other capital providers in this kind of environment?
Yeah, I think that's a really important question because, all capital is not equal in that sense. And I think there's a couple points to make. And one is to have a good understanding of where you sit within the different funds that exist and what those funds do. And you can give a big headline number of money that's being raised to invest in biotech or biopharma specifically. But some of those funds are early stage funds, some are typical venture funds, some are, endowment type funds, others are scale up funds. So within that big number, you have to, figure out what it is that you're particularly good at and where you can actually really add value. And I think, from a charity point of view, and given our network and translational funding already within the UK in particular, we've identified that what we're really good at is really, really early stage translational science and funding that. And so, in our case, I think it would be a mistake to compete with, sophisticated, extremely well capitalized late stage scale up VCs, and so I think you need to have a strategy if you're going to if you're going to try to do something in a very crowded, competitive market, you need to really understand where you sit within that market. And so we're spending a lot of time looking at that. And I think if I were a company trying to raise money, there's a lot of places you can go now, whereas, as you said, 5-10 years ago, that wasn't the case. But if I were a company, I would want to know, what the business model of that fund is, and what the holding periods are, and all that kind of stuff. So you still sort of have to match the capital to the opportunity. And also, I think another point that is worth talking about is the fact that what we're seeing now, and this has been a trend over the last few years in particular, is that investors are, in a sense, kind of trying to industrialize the way that biotech companies and early stage companies are created and funded. And so particularly in the US and now recently in Europe, you really see teams trying to build companies from very, very early stage science. Whereas, before you might have had a seed fund that invested and then it passed to venture, and then there was a scale up, etc. There was sort of a template. Whereas now I think, you've got a lot of very powerful investors who want to have as much control as possible over those companies as they're developing them, and to fund those companies through to IPO or exit, where they can really capture the late stage returns that they otherwise might have had to give up if they couldn't fund the whole way through. So I think, if I were thinking about, commercializing my IP, if I were a scientist or an academic, I would really think about, what kind of fund you want to work with, who do you think what kind of business model suits what you want to do, and really think about that, because capital is, in some areas of healthcare, it is much easier to find the source of capital. Although, I've said this to people recently, and they've said, well, it wasn't easy for my friend who was raising money in a specific area. So there's still lots of people out there who find that in certain subsectors it's still tough going. So I think Nooman mentioned, diagnostics was a bit tricky before COVID, for example. So, yeah.
So thanks, Claire. I think I'd be interested in Nooman's observations on that. And also, part of the report, Nooman was quite interesting, is that, where new VC funds are being raised, the focus, the stage, size of those funds. But I think it'd be interesting in your observations on what Claire said, but also talking about those trends, because they obviously, as you said at the start, they point to the future of where we'll see life science capital investment. So what are your thoughts, Nooman?
Yeah, first I'd echo what Claire said about the sort of specialization. You are seeing, I guess, trends, the atomization to a certain extent of investors deciding where they can really add value on the one hand. So are they sort of Series A, pre-Series A? You're beginning to see in life sciences also a proliferation of textile incubators, particularly in Europe, which haven't really been part of the scene. And some of them have the ability to, raise some seed investment into the company and then sort of pass it on. So that is definitely a feature of the market. Equally, though, you are seeing, and I think this is especially true in Europe, a sort of diversity of, funding vehicles. So we tend to think of VC, I don't want to get too technical, but we tend to think of VC as institutional capital in a 10-year sort of private fund, a GPLP structure, as we say.
Yeah.
And as we know, in Europe, particularly in the UK, there are alternative structures, and some of those have been developed, I think, due to past challenges of managing these investments, even within a 10-year time frame. So if I pick someone like OSI, Oxford Sciences Innovation, they're structured as a limited company, so it's evergreen capital. And they do, as Claire said, one of the investors she was probably thinking about, that certainly will start up a new company from scratch, take the science from university, and have the ability to stay with it, potentially as well. You are still seeing, though, investors like, Advent, perhaps more traditional, VC investor, continue to do its own startups in collaboration with other investors, as well as invest in sort of Series A, B. And I think you're seeing that because Series A round sizes have over the years sort of crept up. I mean, last year they were marginally up, I would say, on the year before, so about 13 million versus 10 million. But I remember having a similar conversation in the first quarter of 2019, when you were routinely seeing these sort of 50, 60, 80, 100 million Series A rounds. Now that hasn't gone away entirely. And of course, when you think that a good size for a VC fund is 250 to 400 million, and that's got to cover maybe 15 deals. I mean, you don't need to be a mathematician to sort of work out that too many Series A deals of that size, you just can't do enough of those deals. So I think funds like Advent and others may have found themselves squeezed out of some of those larger Series A deals and compensated by coming a little bit earlier, which is no bad thing. I mean, it may and it sort of mirrors. We can perhaps talk about this later, but it mirrors where the exit environment in as well, because you've got to think about the whole cycle, of capital. It's all very well getting into these deals, but as Claire will know, getting out is the real black art.
Well, and getting out with any sort of equity left, I would say, is the black art.
Thanks to you both. And I think we can, we'll definitely revisit the exit question towards the end of the panel. But I just wanted to make sure that we spoke to James, because actually another kind of key phenomenon during the pandemic has been increased participation from retail. I'm based in the US, and all we hear about is the Robin Hood trading phenomenon. But there's actually been a lot of activity in the UK and other countries from a retail perspective. So I'd like to just move on to James and say, let's talk about that trend. What changes have you seen in terms of retail participation in the stock market since the onset of the pandemic?
Thanks, Chris. So look, I think the UK has followed a very similar pattern to the US and indeed markets globally, as you've seen greater participation from individuals buying into public markets. I think setting the scene, and this is perhaps just for amusement's sake, if you go back to the 1950s, the entire public market was owned by people. There were no institutions. By 1985, you had about 30% of the market owned by individuals. It hit a low in 2009 in the UK at sub 10%, and today it's circa 14% and rising. I'd actually hazard a guess that that's a historic number, and given level of activity this year through the pandemic, in the UK, circa 15% of PLCs are owned by individual retail investors. That spans north of 20% on AIM in cases, and more typically 10-11% for the FTSE 100. The number is growing faster than at any point I can remember. My point about mentioning history is I think we are reverting to a mean that's somewhat higher than where we are today. We're obviously way off the US at closer to 40% ownership by individuals. But I think what's interesting is when you look at trading patterns, retail investors have been opening accounts with brokers at a rate of knots. And what we know from talking to the likes of Hargreaves and AJ Bell, Interactive Investor and so on, is that it's largely ISA and SIP accounts with enormous pots of cash that are sitting on account. And we're still to see most of that deployed. So we don't believe this is a flash in the pan. We think there is a renaissance of an awakening of understanding of the value of public markets, the availability of information, and the ease and low cost way that you can participate in what is arguably the most attractive asset class by historic performance. And so, as I say, we're optimistic that this is not a moment in time, but is a trend to follow.
And so let's move on to the healthcare sector, because that's our focus today. Based on previous years and also the deals that Primary Bid has been involved in recently, have you seen an increase in interest from retail investors in the healthcare sector?
Yeah, good question. So if I look at the last 3 to 4 years, it's been pretty consistent. About 10% of the deals that we've done are in the healthcare sector. What's interesting is if you look at what that meant through from the beginning of the pandemic to today, we've had 7 or 8 transactions with healthcare businesses. And interestingly, actually, it's healthcare where we've seen the greatest level of engagement from retail. So we've seen on average that the retail book has represented up to about 30% of the overall demand in the given transaction.
And those are, I mean, I think you're looking at from a UK perspective, but I assume that, if we were looking at the US, we'd probably see similar kind of levels of interest.
I believe you would. And I think it's interesting to look at where there is a trend of interest, whether it's for technology or for healthcare. I think those two sectors are garnering a growing level of interest from individuals.
So why would a company want to have a reasonable amount of exposure to a retail investor base? What can we say about, because I think there is a lot of misconceptions about retail as a constituency. So, if we've got companies watching this today, what would you say to them about why they should be considering including retail tranches in their capital raising?
I think for the last 2 decades and perhaps more, there's been a growing misperception and a sort of base misperception that the retail investor is at one end an unknown missold pensioner and at the other end a day trader. And if I can just be really basic on this, I think there's a bell curve. And I think what's important to state is in the middle is the bulk of the community that buy and sell shares on their own account directly. And it's interesting when you canvass data from across the venues that trade on behalf of retail, and indeed, of course, the broker platforms that hold money on account for retail investors, what they'll tell you is actually holding periods are typically 3 to 5 years. And what we've seen is where you've had IPOs that include a retail tranche, it's very, very interesting to see how the positions that were taken out at IPO have typically increased over the following few years. We've seen that evidence from Hargreaves Lansdown and AJ Bell and so on. So I think that's an important point to make, and especially in today's world where so much of the public company register is either passive and index driven or is quant based, and therefore it's electronic flows that are pushing through the markets day to day. So actually to build a heartbeat of the right percentage of your company owned by individual investors is very valuable, both for the transaction in terms of price insensitive demand. We build a book of demand at strike, meaning it's price insensitive, but also we know that by galvanizing and enfranchising individual stakeholders in a company, you create further support in terms of aftermarket and daily liquidity. And as we've seen through the pandemic, a lot of the resurgence and recovery in markets was led from the fact that you had net far more buying activity from retail investors than counter selling activity.
So actually that takes me to my next question. Actually, be interesting Claire's view on this, given her background. So how easy is it? Because you just talked about how you build the book. How easy is it to incorporate a retail offering into either a secondary or even an IPO when companies are doing capital raising?
I think now it's very easy. I mean, James can speak to that more than I can, but I don't think there's a barrier to finding a way to do that and to include retail potential shareholders or existing shareholders in any sort of equity raise. I think that there is still a nuance when you talk about biotech specifically in the markets, because retail investors on the whole probably aren't, expert, scientifically knowledgeable investors. And so the onus is on the companies to make sure that they explain all the risks and the business plan and the development plan in language that all investors can understand, so that you don't have retail shareholders overreacting or underreacting or reacting in an odd way to news flow. And then this often is compounded by the fact that, particularly in the UK, for small cap companies, they tend to be fairly illiquid. So when you have small numbers of shares changing hands, it can make a reasonably substantial impact on the share price movement. So although I agree with what James said, and certainly, I think that retail shareholders are now perceived to be and are more, known to be more valuable, I think there is a nuance that applies to biotech specifically that can sometimes be troublesome for companies that have limited liquidity.
I think that the wonderful world of biotech, there are businesses that contain what might be seen as a binary outcome, and one's got to be very aware of what that means in terms of an investment case and giving full information to any investor. I also think it's interesting that a lot of healthcare companies have quite a long time horizon in terms of realizing the investment opportunity. And what we're finding actually is that individual investors have, in some cases, longer time horizons than some of the institutions who may have to report quarterly or see that periodic performance, which, when you're going through phase trials, means you really do need to look beyond the end of a given period or several. So I think there's a balance there, and I think equally, what I've seen all too often in my institutional career is raising capital for a biotech company from a very, very good quality list of institutions who are then sitting and waiting for some sort of catalyst. And without that, what you find is you get nominal liquidity, which I guess is the point that Clare is making. But therein lies the right balance, which is required of making sure the company has the ability to communicate with tangible information, and indeed to maintain that balance between an institutional profile of shareholders and retail shareholders, who, quite frankly, are becoming a recognized and very important element of any register by the institutions. Because as an institutional fund manager, what you don't want to find is that you are locked into maybe a double-digit percentage of a business with no liquidity with which to change your position. That presents risk, and so actually creating liquidity with some element of retail engagement is a very valuable and strategic move, but it's about getting the right balance.
So I think it's interesting that in the past, especially in the UK, but to a lesser extent in other countries, that there has been a move towards investment through IP commercialization vehicles, or just investment vehicles that invested in life sciences more broadly. Certainly in the UK, we saw a lot of that, companies like Syncona and IP Group. I'm just interested to hear from the panel as a whole, if we think there's a move away from that kind of investment, certainly from a retail investor perspective, to invest directly in those kind of companies. Obviously, Clare, you have a background in this kind of area, so perhaps we can start with you and ask you what your feeling is about that kind of investment approach.
Sure, yeah. I mean, I'll hand over to James to speak directly about the retail level of investment, but I would say that I think that these vehicles do offer a really good way to get exposure to the sector without having to take the investment decisions yourself. So, you know, if you're a private retail shareholder, you're interested in healthcare, but you don't know where to start, you know, what you really need to do is to diligence the management team that run these companies, these investment vehicles, whichever you're looking at, and decide whether or not you agree with their business model, they have a good track record, and have a look at the portfolio. And actually, it's a really good way to get exposure to the sector. A lot of them, you know, have very specific areas that they focus in and different strengths and weaknesses. So I do think it's a good way to put your toe in the water in terms of investing. I think in the UK, that's probably more widely used by investors than in the US, where typically you would see investors pick very specific stocks, and they have more of a stock picker mentality. But I think that there's still, you know, a really valid place for investment trusts, investment companies, IP commercialization companies in the UK.
James, any thoughts from your side?
Yeah, so picking up on that, I mean, I think in terms of IP specialist companies, as you say, you mentioned two, IP Group and Syncona. They're pretty specific and unique. They've had a very good following, both from institutions and indeed retail investors. And in fact, I think what we're seeing now is, whether it's for those portfolios or indeed specific individual companies focused on whether it be biopharma and oncology or otherwise, that there is a growing awareness of the fact you can invest in that sort of rifle shot of single company exposure. And I think there's a big reason why retail investors are seeking out investments themselves, and that is because risk parameters around the wealth management industry mean that you know, stop lists of what an advisory portfolio can and cannot invest in is pushing the onus much more onto the individual investor. And I think that will likely continue. And it also comes back to the fact that so much more information is available today on a given business and the surrounding sector to be able to make an informed decision. So that's very interesting. Clare just touched on investment trusts. And in fact, prior to the pandemic, as Primary Bid, what we found is that we were focusing a lot of our time on the investment trust market, because by nature, what you get is a portfolio approach, and therefore some hedging in that spread of exposure. And indeed, that feels very applicable to retail investors, where you've got permanent capital and, you know, quoted NAVs on a regular basis. That's a part of the market that I think is underserved and has plenty of growth going forward.
Yeah, I could add to that. Actually, I think one of the key points, it depends on what company you're looking at, but one of the key points is you have to also consider what it is that you're getting exposure to that you couldn't otherwise get exposure to. And actually, for companies like Syncona and others, you know, you're getting exposure to effectively privately held biotech companies, or you know, and other vehicles have a similar sort of model. So you know, it's very well. I'm not sure how a private investor would get exposure to private biotech companies otherwise. I mean, maybe Nooman could sort of point to some other structure that would function like that. But I think actually, if you're a retail investor, I'm not sure how else you can really make a play on those companies, because otherwise you're just dealing with listed securities, and you know, one could argue that at some point there'll be value released from the private companies as they grow and as their valuations increase.
So Nooman, do you have any thoughts?
Yeah, I mean, just on that point specifically that Claire raised, I mean, what you do have in the UK, of course, is a large number of actually quite sophisticated sort of VCT and EIS funds that focus on the sector. They're getting in obviously very, early. I think just on the general point about these IP commercialization vehicles, I mean, we've been fortunate in the UK to have a bit of experience. So I appreciate this as a bit of hindsight talking, but I think they seem to have been developed to solve a particular UK problem, which was it was hard for individual companies to exit. That there simply wasn't the market reference of companies there compared to, say, a NASDAQ. So the logic is you invest in like a Touchstone or an IP group, and theoretically that makes sense. I think what we've learned, and you see this with the way that Syncona invests, is that works as long as you maintain the discipline of a normal VC investor. And I think that's where in the past, perhaps, Touchstone, certainly when you looked at their past portfolio, it was held for quite a long time with relatively few exits or listings at all. And if you contrast that with Syncona, you can look at companies like Autolus, you can look at Freeline, you can look at Nightstar, which have listed, been acquired in the sort of normal time frame that a VC fund would expect to exit as well. So I think they've actually managed it quite well. The proposition to the retail investor is you can, we're focused on a very narrow range of technology. So it's not only just biopharma, but largely gene therapy. So that addresses the expertise point and this whole information asymmetry, especially in biopharma, that retail investors don't know. So an expert team that does know. And then the team have done a great job at sort of behaving like VC investors, despite having an evergreen investment vehicle. They haven't sort of been trapped by that and thought, well, we'll just build and build and build and put more and more money in ourselves indefinitely and, take it to commercialization. And all investors will say that, oh, if we can get commercial by ourselves, we will. But, most of them will take options that are available, to them. So I think that part of the sector in the UK has evolved, a bit as well. The more pertinent question perhaps is, with the success that Syncona have had, is there room, perhaps for, any more? As I said, Syncona are very narrowly focused on, gene therapy, biopharma. Is that enough? Does that play enough to the UK, strengths, or is there space and demand perhaps for more? And again, I'd perhaps defer to James on that, because obviously the investor base of Syncona is both institutional and retail.
Nooman, I completely agree with you. I think that's absolutely right. And you're seeing, a growing heartbeat of retail interest and support for these IP related businesses, and for good reason, because actually what's telling is how companies like IP Group are now into a harvesting phase and starting to show gains and making marks in terms of valuations and so on across their portfolio, and that's going to grow, I think, in awareness and attention.
I think actually Claire made a good point actually in the US. Obviously, there's lots of biotech companies and other life science companies that you can invest in through the stock market, but it's very hard as a man in the street or a woman in the street to be able to get access to private investments in the sector. And these vehicles actually enable you to do that. And I think that it's not just about life sciences. Obviously, we have a number of other investment trusts that are listed in London, which offer exposure to late stage tech private investments. And I think that that's something that's very attractive to a retail investor base. And we'll talk about the democratization of capital provision. Obviously, Primary Bid are trying to do that through retail offerings for public companies, but these investment trusts essentially allow you to get exposure to the privately held companies, which are very exciting in growth areas such as life sciences. And I think that that's something that has proved pretty interesting in the UK context, and it's something you just can't really replicate yet. Although there are a couple of examples in the US, and I think obviously you could talk about PureTech as one, which started in London and was listed in London. I think Claire may have had some involvement with this company in the past as an investment banker, but now it's just listed on NASDAQ. So that that kind of profile of company was something that really started in the UK.
Actually, I think what you said is really important because it plays into another issue that, as an industry, we're trying and working slowly to resolve, which is at the moment, we have a very small listed healthcare biotech sector. And so, in terms of cost of capital, access to capital, if you're a biotech company in Europe and in the UK, maybe not Europe, but you look to NASDAQ. And so actually, if it's going to take some time to affect a change there, where we can get a more vibrant UK domestic listing environment for those companies, we can at least capture the value of those companies or the look-through value within some of these investment trust and investment company type structures. So I think that that's another way that investors can play that, because unless they're willing to invest directly into the new NASDAQ IPOs.
Yeah, but what I would say is, obviously wearing my London Stock Exchange hat, last year was a really good year for healthcare capital raising in the public market in the UK. And we probably, I think, the best year in about 5 years. Clearly not as much as the US, but the US is a much larger economy and market. The US economy is like 7 times larger than the UK. But what I would also say is what was interesting in terms of capital flows into the listed sector in the UK was we saw a lot more interest from US institutions, which I think is something that I think a UK listed biopharma company would be very happy to see. But also we saw, and we saw this was focused on the small and micro cap space. And in addition to that, and this is probably music to James's ears, we saw a huge increase in interest from the retail investor base. And I think going forward, we're just really, was part of the reason we're having this panel is talking about diverse sources of capital for companies. And I think that the UK has seen an improvement in the environment. Clearly, it's not as the US is white hot, quite frankly, right now for this kind of stuff. But the UK did see that benefit. And quite frankly, I would also say that in terms of share price performance, the healthcare sector was by far the outperformer in the UK last year. So if you think that, the AIM indices hugely outperformed FTSE 100, I think AIM was up 20%, whereas the FTSE 100 was down. A lot of that was driven by smaller AIM-listed healthcare companies, and that was the place to be if you were a stock picker last year in the London market. So that's my plug for the London Stock Exchange.
No, I'm totally with you. I mean, I've been a supporter for many years in previous roles of the UK market, and I do genuinely believe we are going to get there in the UK. It's just not going to happen overnight. We're not going to be able to compete with NASDAQ yet, but we will. Yes. We'll get there.
But again, also my other plug is the fact that we actually do get quite a few interesting companies from the US in non-biopharma life sciences, so in diagnostics and tools and those kind of areas that choose to list in listed on AIM first. And I say we have a couple of those presenting at this particular event, which obviously I'm heartened to see. And then some of those US companies, when they get larger, are able to list back onto NASDAQ. Again, this is me plugging my own business, so I apologize to the audience for that, for my self-interest. Actually, I've received a couple of messages with questions from people who are watching this as we've been speaking. And I think the first one I would like to put to Nooman, which is, to what extent are we seeing interest from the Chinese in terms of investment? I'm interested in the Chinese environment itself, but also outside of China in terms of where they're looking to invest. I think SBB has done some work on this. So what can you share with us about what's going on in China and how the Chinese are getting involved overseas, Nooman?
Yeah, I mean, if the US market was red hot last year, the Chinese market was, was white hot. I mean, overall, again, high level numbers. 2019, you saw 6 billion invested in the sector in China. 12 billion last year, so a doubling. Now, it has to be said that most of the investment that was in China came from domestic Chinese investors. And that leads me to a second point, which is the Chinese have never been slow to invest outside of China for various reasons that we all know, whether it's US, tech companies, or indeed UK biopharma companies as well. Now, the government in China has put incentives in place to make sure that more of that high-tech investment stays within China. So there has been necessarily a little bit of a pullback in their overseas investment appetite, but it's not, significant. There is still appetite there because I think the Chinese recognize that a lot of the very high-tech, cutting-edge healthcare and technology investment opportunities are not in their own country, quite frankly. So they have to do that. So we have seen that trend, hold up as well, despite the increased focus. Now, obviously, that's explained, that apparent contradiction, by, that huge doubling in the overall, investment numbers as well.
Okay, thanks, Nooman. Next question that I've got is for, actually, I think I'll aim this at Clare, and then I'll probably follow up with James as well. We talked about this in the past a little bit, Clare, as well. How do investors kind of integrate ESG or go beyond pure financial returns to measure the social impact of the investments in this sector? Because a lot of people think this sector, just by its nature, is kind of an ESG positive, if you like. But is there more nuance to this, especially based on the type of company and the type of investor that you might be looking at?
Yeah, so I mean, that's a really complicated question because, as you said, I think for a lot of investors who are generalist investors, when they want to invest more specifically for impact and for an ESG purpose, then they may feel that by investing in healthcare, they can massively tick that box, So for some investors, that's as far as they go. But for the big, in the listed markets, obviously ESG is a specialty in of itself. And I'm not an ESG expert, but each pension fund or each fund will have people in the fund that specialize in assessing ESG metrics and making sure that so from an investee point of view, if you hold yourself out to meet certain metrics, there's now sort of more or less some standards together there that people can make those assessments. I think that's an interesting, for us as a medical charity in the private market, it's even more of an interesting question because we have a charitable purpose, charitable aims. We want to make an impact with the funding that we deploy, and actually measuring impact in a very, very highly impactful sector is really challenging, especially when you have no term life, which we do. We have, we can take a very, very long-term view with the capital that we deploy, and it's difficult to say, well, impact means impact on patients, but in this industry, as we've all said, it can take many, many years to get something to a patient, unless maybe it's, digital health or diagnostics, whatnot, where they have a slightly shorter lifespan. But so we've really spent a lot of time, and we are still thinking about, what it means to create impact in the sector. And so to summarize, I think ESG is slightly better understood and slightly better articulated. And there seems to be some consensus building around the types of metrics that you can use to measure ESG, whereas impact within healthcare, I think, is quite a tangled web of and difficult to measure. And so that's a big focus. And I think it will be a big focus rolling forward post-COVID. Hopefully there will soon be a post-COVID time, but I think it will be about, global funds saying, okay, we need to look at impact as well as ESG.
And Nooman, do you see any kind of activity on that front from a private kind of funding perspective, where people are, or funds are specifically targeting kind of impact or social aspects in their fundraising?
Yeah, I mean, only to the extent that, what you've seen at LifeArc, which is a great development, you've seen a number of other charitable institutions embark on this path with their own, venture schemes as well, obviously typically targeted on, particular area of their own, interest as well. And it's still a fairly nascent sector and the models are quite different, but one thing you can draw from the various schemes out there is that, they come in early and they actually use their position at that early stage to set a bit of that agenda. So perhaps rather than, come in with the assumption and say, hey, this is a healthcare company, we're developing, Parkinson's drug, so that's everything ticked in terms of ESG impact because healthcare, they're actually focused on things like governance and pervades the organization, and and it is fair to say that if you look at the other end of the life stage of a lot of these companies when they go public, you can't always look at them and say, well, just because they're healthcare they tick the ESG box. And we know that in established companies in large pharma, and it's not about big pharma is evil or anything like that. It's just that people are human and they make mistakes, and perhaps behavior sometimes borders on the unethical or immoral, if not illegal in a few rare instances. So I think really at the early stage you're beginning to see that happen. But I agree with Claire. I think the impact one is a harder one to get your your head around. I mean, the ESG, I hate to sound cynical, but it is a little bit more of a have you got this? Have you got this? Do you do this like this? Okay, that's ESG ticks. Impact is more of an ongoing monitoring and assessment, and may require adaptation of the strategy of the company as well.
And James, do you think this is a big area of interest for the retail investor base?
Well, all I know is that for the last few years, and this goes back, a while, every board meeting is increasingly beginning and ending with this agenda. And for effect, yes, but there's good reason. And I think what we've seen through the pandemic, of course, is that the world's grown a conscience and an awareness of the fact our health matters. I think when you look at performance of, say, clean tech companies, and if you take the London Stock Exchange's green mark, it's fascinating how those companies have outperformed the broader market, which is a trend I don't think is going away. It's here to stay. And it's fascinating, again, in the investment trust market, the most successful funds have been either health driven or indeed clean technology in terms of energy, clean energy driven. And so I think, as I say, that the world is growing a conscience. That's down to the individual. I think there's a wake up call that as an individual investor, you want to know where your money is going and what you're investing in. It makes you feel good to know that you are investing in companies that are doing right by the balance of the way the world is evolving, especially today. So I think it's a big agenda for individuals as well as for institutions, and they go hand in hand.
No, I agree. It's interesting from an LSEG perspective. We own FTSE Russell, and FTSE Russell puts a lot of work into developing ESG scores, and it often boils down to a single number. But really, when you dig into it, there are hundreds of factors that need to be analyzed to derive that factor. And actually, it's the interest would be in looking into that and, you know, doing things in a kind of more nuanced way. And actually, I think there's definitely a move away from the big move at the start of this move, you know, kind of development it was about the E, it was about environment. So you could do a negative screen, no fossil fuels, that kind of thing. But I think now there's a lot more kind of nuance and granularity into digging into things like the social aspects. And I think social, you know, how you treat your workers, supply chain, all that kind of thing. And I think that's why, you know, to what Nooman and Clare were saying, that there'll be a move towards not, you know, you're not, being a biotech company doesn't mean that you are an impact company or necessarily a positive company from an ESG perspective, because there'll be a lot more analysis done into your operations to understand if you are, you know, as a whole being a positive, making a positive kind of impact. And I think that's the nuance that we'll see going forward.
I think, sorry, Chris, just the other very quick point on that. I mean, we've talked about this in relation to the underlying companies as well, but there is an aspect that relates to the investors themselves. And, you know, we saw there were lots of headlines a few years ago about sort of, you know, white male domination in the tech VC landscape, you know, at the general, you know, partner level, for example. So I think it's something that when you look at that broader social movement, you know, that James was alluding to, that we've all become more aware of, you know, it affects, I think, the entire ecosystem, all the players, not just the underlying companies as well.
Okay, well, I didn't have any more questions for you guys today, but I wondered if there was any kind of, you know, concluding remarks that you wanted to make on, you know, where you see investment trends going forward. You know, perhaps James would like to talk about how he sees the retail environment, you know, evolving, and, you know, Clare and Nooman, I'd be interested in your final thoughts. So maybe start with James.
Look, all I'd say is, you know, having spent enough time over years gone by working in and out of the healthcare sector, I think to the point made earlier, there's been a level of underinvestment for a long period, and we've seen the number of quoted companies, UK or otherwise, diminish. And it's exciting to see prospective IPOs and some very exciting businesses that are now seeking, whether it's public markets or indeed further private capital, for good reason. And I think markets are open for that. I think the fact that this sector is so agnostic to any movement GDP wise, I think is an important point. We're in a world that's you know, difficult to fathom at the best of times. And as a sector, what we do know is that, you know, our health matters. And so whether that's for the individual or otherwise, you know, this is a really, really exciting sector, and we're well placed to work with all businesses, especially when facing public markets, to get you know, best impact from raising capital in the most efficient way possible. So thank you, Chris.
Nooman?
Yeah, I'm just building on one of James's you know, points in terms of accessing these opportunities. I think the UK is unique in that as well. And it also addresses, I think, one of the, you know, kind of canards of the UK industry, which is people bemoan. I know you're doing a session later on, you know, public companies, but people have always bemoaned the lack of a, you know, a public market here for biotech. But I would ask people that think of the wider infrastructure, you know, and that ecosystem in the UK is generally stronger than it was 20 years ago, when people think there was a good, you know, sort of infrastructure of analysts and so on. The venture scene here is stronger and larger than it ever has been as well. You have got, you know, more sophisticated retail investors. There is more news and greater awareness, you know, as well. So it's you know, a fantastic time. And again, you know, those numbers that I talked about at the beginning, this isn't just going to be a sort of a flash in the pan. This is now the continuation of nearly a decade-long trend.
Yes, I think from our perspective, as I said at the beginning, we focus on very early translational research. And, you know, when you think about all of the capital that's in the market right now, in the venture funds, in particular, globally, you know, all of that capital needs to go somewhere. So these people have to put that capital to work. And the standards for investing, I don't think, are going to change. And certainly, you know, why would they? So, you know, what people need now is to match that capital against very high quality assets and technologies. So if you're a scientist or an academic, or you've got an interesting piece of data-driven health or diagnostics, now is the time to really put yourself out there and talk to people about building a company, because that capital needs to be put to work. So it's a great time for the sector, really exciting time for the sector.
Well, I'd just like to, that's a great note to end on. And thank you, Claire, for those comments. I'd just like to thank the audience for watching. I hope that you found the panel very interesting. I'd like to thank the panelists, Clare, Terlouw, Nooman, Haque, James Deal. Really interesting content. Thanks a lot, guys. So I hope that the audience found that interesting and that you're able to catch other content during the event that's going on right now. And just leaves me to say thank you very much for watching, and I hope you enjoyed. Thank you very much.